today's webinar on how to cover public pensions. My name is Mary Jo Webster. I am the computer-assisted reporting editor at the St. Paul Pioneer Press, and I have a co-panelist. I'll let him introduce himself.
Hi, everyone. I'm Jason Hoppin. I'm a reporter at the Santa Cruz Sentinel. I used to work with Mary Jo out in St. Paul, and I've done some work on pensions myself.
So we've both been working on pensions in our respective places, and we found that it takes a little bit of getting up to speed to get started on this. So we thought we'd offer what we've learned to all of you to help you get up to speed, because we think public pensions are a topic that should be covered everywhere. There's stories to be done everywhere, and it's hard to, they may or may not be getting done everywhere. So at the end of the presentation, we'll have a link, a web link to this PowerPoint that we're going to go through, and also to a handout that contains far more information. We'll also have at the end a question period. Right now, you are all muted, so we can't hear you. But at the end, we can unmute you and give you opportunities to ask questions. You could also use the chat feature on the webinar screen that you should see to type in a question or something. So we'll hold questions for the end. We have probably enough material here to cover a long time. We're going to try to keep it to 45 minutes with extra time then for questions after that. And so we might go fast through some things, but hopefully we're providing you enough of the basics and enough of some resources that you can go and dig in further on your own. And I'm also recording this, so if you know people who didn't make it today who might want to listen in later, we'll figure out a way to make the recorded version available to people in DFM in a day or two. So we'll get started here. The first question, of course, what are public pensions? Generally, the majority of them are considered what's called defined benefit. That means that they are promised a certain amount of money in payments for the rest of their life, regardless of how much they paid in at the beginning. So this is really the opposite of a 401k, which is considered a defined contribution plan, where the defined contribution plan is just kind of what you've put in and what you get out of the market returns. The defined benefit plans, they're guaranteed a certain amount for the rest of their life. How these are set up in your state could vary quite dramatically. Most states, I think, have started moving more toward a kind of a statewide pooled system where all the workers are under maybe a system such as the CalPERS system in California. In Minnesota, we have 3 big systems. But there's also usually a few stragglers where there's still a local pension somewhere. Like our St. Paul teachers have their own little pension that's separate from those statewide pooled ones. So one of the things you'll need to figure out is what the situation is in your locality or in your state. It's possible that your city or your school district has its own little pension, or maybe they're pooled in.
Transit workers are another one that have different pensions. You might look for that.
What kind of workers?
Transit workers.
Transit workers, yep. These plans are heavily reliant on investment returns. And we'll talk a little bit more about how they work down the road, but that's a key point to keep in mind. I think in Minnesota, something like 60 or 70% of the revenue that's generated to pay for benefits comes from investment returns, not from the taxpayer dollars that go into the fund at the beginning. The other key point is that employers are obligated to pay this regardless of what happens to them down the road, and Jason's going to talk more about that. That's becoming a huge question right now, and Jason will talk about that a little bit more in a bit. And the risk falls entirely on the employer, unlike the 401k where the risk in the investment market is on the individual. And a couple other points we don't have on the slide are that politics play a big role in this as well. Generally, lawmakers make a lot of the decisions on how these pensions, the policy behind these pensions. And over the years, we've seen that it's at the whim of the lawmakers. If they feel like, oh gosh, we should increase these benefits over here, let's do it. Or there's also lobbying involved against those lawmakers. So that plays a big role in what happens in funding these plans and running them and the policies behind them. And the other thing is that it is quite common for extra tax dollars to get pushed into these funds to help them when they're in trouble. So it's not just the contributions that are coming out of the employee's paycheck and from the employer, like a city or the police department or the school district. Sometimes there's extra money from like the state general fund that helps support particularly a struggling pension. Jason.
And just to sort of add to that, to put a finer point on it, a lot of the workers that benefit from these pensions are public workers that are represented by unions that are pretty important in getting those same elected officials into office in the first place. So there's sort of a circle there.
And they tend to be the biggest lobbyers in terms of making changes to these plans. It's the union people.
Yep. So you'll also notice that there's a big difference between public and private workers when it comes to pensions. About 78% of local, state and local government workers are in defined benefit plans, whereas they're almost non-existent anymore in the private sector. There's only about 3% of private workers that are on defined benefit plans. There are about 15 million workers in a defined benefit plan, and that's about 11% of the nation's workforce.
In the public
Again, largely
sector.
public.
Yeah, that's
workers.
all public.
Yeah.
So how does all this work? The basic premise of a defined benefit plan is that each generation of workers pays its own way. The idea is that they put in contributions during their working years, and that combined with the expected investment return should be enough to pay for their benefits in the future. And it's called kind of a pre-funded system. Pensions didn't always work this way. Up until quite recently, they were considered pay-as-you-go. The money came in and it went straight out to retirees. But now it's more this pre-funded kind of setup. And it's all hinging on a set of assumptions. And assumptions are tricky, very, very tricky. So this whole premise is assuming that you're going to get a certain investment return. If you don't get that investment return, something goes wrong. It's assuming that you're going to live, this worker is going to live a certain number of years and collect benefits for a certain number of years. What if that goes wrong? It's going to assume that they're going to work a certain number of years and make a certain salary. All these things can go wrong and cause havoc. And this is one of the key things we're seeing right now with plans, is that they're getting into trouble partly because people are living longer and those assumptions are falling short. And then, of course, the big thing is in the past 10 years, the stock market has not returned the kinds of investments that they really need and expected, and that is introducing shortfalls into these funds as well. Generally, these plans are set up so that an employee contributes a certain percentage of their pay. It's usually between 4 and 6%. And then the employer usually contributes a similar amount. I generally see that like a general state or local worker, like a clerk or a secretary or someone not in public safety, they generally have an equal. So like the employer will pay 5% and the employee will pay 5%. In the public safety world, it's usually that the employer pays a much higher percentage, and this largely has to do with because most public safety workers are not eligible for Social Security. There are other public workers who are not eligible. In some states, teachers are not eligible. There's some states where all state workers are not eligible, so that's a key thing to know about your state, who's eligible and who's not, because those contributions will look very different depending on that. and the benefits that they receive would be quite different as well. Someone not getting Social Security is going to have a higher benefit than someone who is eligible for Social Security.
Could I just add to that?
Yep.
In Santa Cruz here, an employee and an employer typically pays into a pension. In Santa Cruz and a lot of other cities, the employee contribution is fixed through collective bargaining. So say it's 8% for a lot of county workers here. The employer contribution fluctuates based on what the pension fund thinks it needs. So those will change from year to year. We'll show you how to look at those later, but it can be as high as 25% of your total payroll is going towards pensions.
Yeah.
And that's something to look for.
Other states that collective bargaining is not involved. Minnesota, it's not the case. Our contribution rates are set by the legislature, and so we have a different problem in that the actuaries will say the fund needs a certain amount in contributions to be healthy, and yet let the legislature set those rates at 2 or 3 or 4 plus years ago. And so there ends up being a gap between what they need and what's actually coming in contributions because of that lag time. Other states, I know Wisconsin, for example, those rates are just automatically adjusted from year to year depending on what is needed, and there's no collective bargaining involved. So that's another key thing to know. The other thing to know is a basic thing is that there's generally the benefits, there's a formula that's used to calculate the benefits. And it might vary from plan to plan and state to state, but generally there's a multiplier number they multiply that times your years of service times your final average salary. And the final average salary, that is going to vary from state to state as well. Sometimes it's your average of your highest 3 years or your highest 5 years, or it might be just the average of your last 3 years. It used to
California
be that
until the first of this year
yeah.
in California, it was your highest year period. So that
ended
up being a big problem.
Yeah, a lot of states are moving away from that. I've heard recently that there's a couple of states who've actually gone to the average of 8 years, which is really extreme. Most of them are in the 5-year range right now.
Yep.
And that multiplier I mentioned is usually something like 1.9 or up to 3 I've seen. I don't think I've ever seen anything higher than 3. In Minnesota, 3 is the public safety one.
Right. So that the way this sounds is they'll talk about formulas when they talk about pensions, and they'll say something like 3 at 50. And what that means is you're eligible to retire at 50 years old with however many years you served times 3%, and that would be one of the basic ways they calculate your pension. So those formulas can be 2.5 at 60, 2 at 65. They just change depending on what the classification of employee is.
Jason, the money.
Yeah, so what we really want to impress upon you is the phenomenal amount of money involved here. Nationwide, their pension funds have about $2.8 trillion in assets. I think CalPERS is the biggest pension fund in the country, and that has about $240 billion with a B dollars in assets, and that's almost twice, I think, what Apple's cash hoard is, if you've ever heard about how much money Apple has. But on average, these things are not fully funded, which means if you project out, they don't have enough money to pay for all the commitments that they've made to all the workers, and that is about 75% sort of globally nationwide. This is a big point of contention. Your unfunded liability, that's called an unfunded liability, and that changes based on how you look at it, based on the investment return assumptions that you use, based on accounting standards and a number of different things. There's also a debate about how much you should focus on that figure going forward. If you go to the next page there, is the sky falling? This is a map from the Pew Center on the states that shows generally what the unfunded liability is in each of the 50 states. This map has received some criticism because it's basically an aggregate of all the many pension funds. Maybe it doesn't include all of them in the state, but it gives you sort of a general picture, and it's kind of the only general picture that will show you how your state might compare to other states. You can see Wisconsin looks to be doing quite well. 80% is pretty good. Minnesota is pretty good. California is pretty good. Illinois is terrible
Yeah.
at 45%.
One caveat there, so like Minnesota, it is not including our 2 local plans. We have 2 teacher plans, local plans, and those are only 60% funded. So when you throw them into that average, that brings us down into the 70 range. So we're not really 80% funded, but just in terms of comparing the states, this is as good as you can get to be able to see, is your state in the sky is falling mode. Generally, Illinois is considered, yes, sky is falling in Illinois, and then it kind of goes out from there.
Right. So what you can do is I can look at the Santa Cruz Police Department and ask them what their unfunded liability is and figure out how much in dollars that is, and there's a pretty easy story to do right there.
Yeah. So why are some plans in trouble? When you go out and start reading about pensions, you will find some people who are saying the sky is falling. You'll find others that are saying, no, 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 everything's fine. As soon as the stock market starts to recover, we're going to be all fine and dandy. You'll find people down the middle. It's really all over the road. I think everybody agrees, though, that the stock market losses, particularly in 2008, were very detrimental to pretty much every pension plan in the country. And most pensions write off their losses and also smooth out their gains over a 5-year period. So we're just coming out of, they've smoothed those losses out now, and we're just in the 5th year of that, and everyone kind of thinks everything's going to really perk up next year. But almost every pension state in the country, I think it's like 45 states out of 50, have gone to their legislature in the last 3 years asking for changes to help prop up their pensions because of these losses, and maybe also because of other things. So the other things that might cause a pension plan to be in trouble, in the late 90s, most pension plans were overfunded. The stock market returns were huge, and there was just this flush of money, and a lot of legislatures chose to improve benefits at that time. In Minnesota, we enacted, lots of early retirement incentives that allowed people to go out early and get, benefits for much longer. We gave away 10% annual cost of living adjustments, maybe change the benefit formula, all those kinds of things that as soon as the stock market tanked, starting in 2001 and into this past decade, suddenly the pension fund managers were like, oh no, we really screwed up. That was a really bad idea, because now we have this commitment to these higher benefits and we can't make it go. The other thing is the idea of what's called a contribution deficiency. So that would be a gap between what they're actually paying in and what they need. And I mentioned that earlier. We have that in Minnesota. Just about every plan has that problem. And this would not occur in a state where the contribution rates fluctuate automatically depending on what is needed. But if the fund is not putting in the amount that the actuaries say they need, there would be a deficiency there, and that would contribute to the unfunded liability every single year, regardless of how the stock market is doing. The other thing we've seen in other states is the employer not making the payments, where they just simply didn't pay their share into the fund at some point in time. And a whole bunch of money is owed to that fund, and so like a city or a school district or a county is suddenly faced with they need to pay that money in, and the pension fund is short on money because they didn't get that money when they were supposed to. I already mentioned the retirees living longer than expected. That is throwing off a lot of the assumptions, and people are getting pensions for much longer than anyone ever expected. And then a fund will also get very much in trouble if the ratio of workers to retirees starts to flip and there's more retirees than workers. That's when a fund really gets into big trouble. And And so that's another thing for you to look at, is what that ratio is of workers to retirees and where your fund is at.
Right. On to Stockton, California. You've all heard of Stockton declaring bankruptcy. It was the biggest municipal. It is the biggest municipal bankruptcy in U.S. history. The judge certified it earlier this month, I believe it was, but he kind of put off a big question that a lot of people are looking at, which is, can you cut benefits for existing employees? The assumption has long been no, you can't. Those are commitments that a government will have to keep throughout that worker's life. But there's a creditor in that case which is saying, I know that the city of Stockton wants to keep making its contributions toward its employees' retirements, but why shouldn't CalPERS be viewed as any other creditor and have their payments cut like we are? So the judge had that question before him. He certified the bankruptcy and he put it off for, it'll be coming up within the next few months, but a lot of people are looking at that decision. Bankruptcy cases are federal cases, so there's the potential here for national impacts. And you can see a quote there from Judge Klein, who seems to realize that he's got a big question in front of him.
Everybody I've talked to in the pension world has their eyes on this case right now, and they're all saying, if this judge allows Stockton to reduce its payments to CalPERS, basically not pay everything that it owes, there could be a very quick run to the bankruptcy court by a lot of other cities who are struggling with pension obligations.
Right. It could actually inspire a lot of cities to go bankrupt.
Yeah. So keep an eye on that one. So how do you start getting up to speed, in addition to listening to what Jason and I have to say to you? These are things that I did when I was getting up to speed. The first basic question, of course, is just figuring out how the pensions are set up in your state. Is there a pooled system? Is it local? Are there local pensions? What are they? And then who oversees these funds? Is there an outside auditor or somebody who's outside of the system who is keeping an eye on them and doing regular reports on them or audits? In Minnesota, we have a legislative pension commission that is made up of lawmakers from both chambers of the legislature, and they have a full-time staff, and those staff members regularly issue reports about the funds. They're not quite as good as an audit, but they do offer some criticisms and point out problems and weaknesses and issues that they think the lawmakers should be addressing. So that could be, something like that could be helpful to you. And then we're going to talk in a minute about annual valuation reports. Every fund should produce, an actuary actually does this. They produce an annual valuation report that has a lot of very valuable information in it about the financial health of each plan. And then, of course, the other thing, this is Journalism 101, finding some local experts. I found a former legislator who had served as the head of that pension commission for a long, long time, and he was willing to sit down with us and just, chat very informally and help give us some insight into how things work. I also found the legislative auditor was extremely helpful because he had done several reports about the system and just was willing to share his knowledge with us. So if you can find some people like that to go and have just to sit down and say, okay, I'm reading this stuff, give me the big picture. What does it mean? How do I put it all together? The last couple of things are looking at what legislation has been approved in recent years, and our handout has a couple links to organizations that have been tracking pension legislation around the country, and they have it broken down by either year and or state, so you can go find your state and see what legislation has been approved, so you can be up to speed on what changes have recently been made. And then there's just tons and tons and tons of national reports, and our handout has links to the ones that I felt were really useful, and there's the organizations that produce them have many, many more reports other than the ones I've linked to, but they can help you understand and give you the broad picture from state to state.
I just want to really endorse those valuation reports too. They should give you a lot of basic, easy-to-read information, and you can get them from, I think I got them from the Human Resources Department of whatever agency you're looking at.
Yeah, and like the pension funds in Minnesota, they put their valuation reports right up on their website, so I was able to get them. And then I also discovered what you're seeing here is a spreadsheet that the Pension Commission in Minnesota puts together. They take all those valuation reports and they punch in all these numbers from each fund. So for example, this is one pension system of the Minnesota State Retirement System, and you'll see it's got different columns for each year's valuation report. And this particular one goes back to like 1950, all in one spreadsheet. So it's amazing. But it has all of the key things that you want to look at. How many members they have, how many are workers versus retirees, what their assets are, what their unfunded liability is. That's on line 14, it's kind of cut off. And then there's their funding ratio. You can see in 2012 this fund was about 83% funded. So that means they have enough assets to cover 83% of their future liabilities. And then you can see how much it costs them to run this thing. That's the normal cost. You can see how much is coming in employee and employer contributions. And there you can see the percent of payroll, so 5% and 5%. That's the percent of payroll that comes out of from each employee. And then you've got the dollar amount that equates to, that went into the fund that year. And then at the very bottom you can see the deficiency and surplus. And so this particular fund is deficient by about $60 million each year. They're adding that much to their unfunded liability every year. And that is about 2% of their payroll. That's how they express it. It's very strange. I have not figured out a good way to explain that to my readers, that percent of payroll thing. It makes no sense whatsoever. And then at the very bottom they're saying amortization target date. It's a really big, scary word, but basically that means that they're planning to pay down all their unfunded liability by 2040. The really scary part is that the legislature just keeps moving that date out farther in time, over and over. They get close to it, they just push it out another 20, 25 years. And so I'm waiting for them to push it again sometime soon. You can see on the spreadsheet where they've pushed it. It used to be at 2020, and now they've pushed it out to 2040. One thing I wanted to point out is that I took these spreadsheets and created some interactive graphics for my readers. You can go to twincities.com/pensions to go play with this, but it's all these 40 years worth of valuation reports in various charts, and readers can go through and adjust the charts by date range and which plans they want to look at and things like that. And so it's taking this information and making it a little bit more useful for readers.
And so we want to talk about some of the things that are going on right now in response to some of the market conditions for the pension funds. These are all probably easy stories to do, and if they're not doing them, that's probably a story too. So one of the things you're seeing is that employees are being asked to contribute more towards their pension, and that's going to take away from their paycheck. So that's going to be a source of heartburn for a lot of people. The other thing that is happening is employers, and this really is happening in California, are being asked to contribute much more than they had been towards employee pension. That puts a strain on all other areas of the budget. That affects roads, that affects parks, that affects how many other police officers you can hire, because they're sending away more money to the state or to the pension fund for future costs. Another thing you'll see is that pension. You'll see people that retired 30 years ago that are now making more in their pension than they did when they retired in the first place, and that's the reason for that is because there's a built-in cost of living increase for retirees, and that is being reduced in a lot of cases, or even eliminated for some years. It doesn't. They'll do it for 1 year, 2 years, 3 years, and then it'll come back. They're also changing the benefit calculations, and that's one of the things we talked about earlier was that formula, 3 at 50, 2 at 60. Those formulas are being changed, so it encourages people to retire later. The catch here is that none of those formula changes are affecting current workers. They only affect new hires. So while there is a savings it starts to accrue in the next few years, the really big savings don't kick in for 30 years down the road until the people that you just hired actually retire. So all these benefit calculation changes are really kind of a future fix. And another thing you're seeing is a few states are trying to maybe get out of the defined benefit business with hybrid plans. This is something the federal government did a long time ago. A lot of people look at that. They can be a mix of Social Security, 401k, and a defined benefit plan, and those are called hybrid or sometimes DC plans.
And the other thing we're seeing is changes to like the retirement age, pushing it higher to like 66, like it is with Social Security, or making it a little less financially attractive for someone to retire early, because generally when someone retires before that, quote, normal retirement age, they would see a reduction in their benefit by a certain percentage each year that they go out early. And so they're kind of, I'm seeing more and more states like take that away, make it harder. And I just did some interesting reading yesterday about this topic. Apparently, a lot of states put these early retirement kind of incentives in place because they wanted their workforce to retire. They didn't want them to stick around forever and ever. And so they would, you know, when people kind of got past their peak and started to go on, quote, the decline, they wanted them out the door. Well, now that whole kind of thing is being turned on its head, and they want people to stick around because these pension funds don't want to be paying out 40 years worth of pensions. I've heard of, you know, some experts saying because of these early retirement things, it's quite possible that a person could receive more money over the course of their retired time than they did as an employee, because they could be retired for 40 years. So it's an interesting thing that's going on.
So one of the other things that happened here in California was they pushed through a package of pension reforms, and you might use that word lightly last year. I included a primer. I'm sorry, it's 40 pages. If you're a nerd like me, it's going to be interesting. But a couple things to keep in mind about that package of reforms that came out of Jerry Brown's office. The changes largely apply to new workers. So a lot of these benefits will take years to kind of move into place. Some of the formula changes are significant. That's one of the ways they push off the retirement for workers, is to change it from 2 at 60 to 2 at 67. So there's no incentive to retire before 67, and you actually have people contributing to the pension plan longer and taking retirement benefits for a shorter period of time. One of the things they did that got a lot of attention is they capped the accrual of benefits beyond certain salaries. So if you make over 110 or over 135,000, your pension benefits are capped. There are very few people, relatively few people, that make that much money. So the savings there is not extremely significant. One of the other things they did was California had they just used your highest 1 year of pay as a basis for calculating your pension, and what people were doing was they were taking 1 year and working as much overtime as they could possibly get. They were taking 1 year promotions, they were driving up that 1 year of pay, and so they're trying to smooth it, and they actually have excluded general overtime from the calculation, so that should help a little bit. Another criticism that you would often hear is of people retiring, taking a pension, and then being rehired back by the agency that they used to work for. They are trying, sort of, to stop that with a 180-day sit-out rule, but there's a couple giant loopholes. Number one, it doesn't apply to public safety workers, which is kind of where this often happens, especially with police chiefs. And then there's another. The biggest loophole is the agency just has to certify that they need to hire the person in order to get around the 6-month sit-out rule. So, I mean, what really is that doing? The other thing they did was they sort of eliminated something called airtime, which allowed people to buy years of service. So you could pay often a relatively large lump of money to buy added years of service, that would increase your benefits. And what you're doing basically there is gambling that you're going to live longer, that airtime would be worth it to you. So they eliminated that, except they still offer it to people that served in the military can buy their military years of service as airtime, and then people that worked for a county or a city and were not in a pension plan for a couple of years can go back and buy those years.
One other thing I'll mention on the reforms, Jason, you talked about California. One of the things on your handout is the Center for Retirement Research at Boston College has done a study kind of looking at how effective are these forms really going to be, and they raise some of those questions that Jason talked about, and they talk about all the states that have done reforms. So that would be a good one to look at if your state has been doing some reforms. So what can you look for? What kind of stories should you be putting on your to-do list? The easiest one, of course, is what are the unfunded liabilities in your state, and how are the pension funds in a position to be able to pay those off? You know, what's their financial standing, basically? Are there contribution deficiencies? Are there some kind of intrinsic financial problems with the funds that are causing them to be in greater trouble? Is it something more than just the stock market decline of 2008? And the main way to go at that would be to look at those valuation reports and talk to experts about what you're seeing there and what that means. And it's a pretty easy story to do. And one of the examples I'm going to show you is the story I did from Minnesota. That was the whole story. How are we doing, basically? The other one is there any fraud or other questionable practices? Fraud is pretty tough in the pension world, but you never know. The questionable practices thing is possible. One of them is what's called pension spiking, where workers, either work an excessive amount of overtime, get some kind of extra perks during those years when their final average salary would typically be calculated, their highest earning years. And we'll talk about some other questionable practices in a minute. The other one is, are the benefits too generous? And here's where maybe you can compare that multiplier in your state versus other states. If there maybe there's some people in your state who are talking about whether or not the benefits are too generous, particularly in comparison to the amount of money going in from contributions. Is that balanced okay? And same thing with the cost of living adjustments. Have those been too generous at some point that's causing problems with the fund? In Minnesota, they used to allow the cost of living adjustments to be based on the investment return. So when the stock market was booming in the late 90s, the retirees were getting 10% bumps every year. It went on for like 5 years. And those are compounding. So 10%, and then the 10% on top of that new amount the next year. And that really hurt Minnesota's pension funds. I think someone estimated at some point that it contributed somewhere in the neighborhood of $7 million to the unfunded liability, just those like 5 years worth of huge benefit increases. The other big one, and this is one that I'm working on now, please don't tell my enemies in Minneapolis, is how much is this costing the taxpayers? So what I'm trying to figure out is how much is, like St. Paul, the city, paying in to the various pensions that cover their workers, and how does that, what percentage of that is that of their total budget, and how has that changed over time? And I'm hoping to be able to see, I'm already seeing that their costs have been going up. And I am hearing from the financial people in the city that it is a big concern. So then the next question is that crowding out other things on the budget? Are they not getting out to fix the potholes on the streets as quickly as they should? Are they not being able to hire more police officers or buy that new fire truck, or, or we're having the issue where they're closing recreation centers in the city that a lot of our low-income citizens rely heavily on. Is that, being crowded out because of pension obligations? That's going to be a little hard to ferret out, but it's a really good question to ask. And at minimum, looking at how much the city is spending on pensions is really important. The first thing I did was pulled up the city budget, and the word pension does not appear anywhere in the budget whatsoever because it's all lumped in to the salaries and benefits line item. So citizens probably don't have any idea how much is being paid in. The other really simple thing you can do is watchdog whatever's going on in your legislature. We have probably 5 different things going on in Minnesota right now that I'm covering on a daily basis. I've, going up to the legislature, listening to hearings, things like that, making sure my readers know what's going on. I got a huge outpouring simply from a story about one of the proposals is to add a $5 surcharge to every homeowner's insurance and car insurance policy in Minnesota to help pay for police and fire pensions. And I got so many readers who were just totally ticked off by that. And it's totally being buried by every other media around here and the lawmakers. They're just kind of like pushing it along. But my readers clearly want to know that that's happening. And then the other question that kind of Jason touched on is, will these current reforms, could they be a problem down the road for hiring, for workforce? Right now they're changing the formulas and the benefits and everything for new hires. So we're going to reach a point in the not too distant future when we have half the workforce eligible for these really awesome benefits and half eligible for lesser benefits, but they're still paying in more money. And that, I'm guessing that's going to cause some friction in the workplace. Could that also cause difficulty hiring in the public sector? That's one of the questions that the Center for Retirement Research brought up in their study. They do think it is going to be a problem. And then the last thing, this is kind of a little bit in the weeds, so it depends on how far you want to go. But the General Accounting Standards Board issued some new standards that cities and pension funds have to follow. Starting this summer, they will have to be more transparent about their unfunded liabilities. And it's going to have to be part of their financial reports, like the cities. What I've heard about this mainly is that it may not necessarily affect a city's budget, like they won't have to balance that out with their revenues. It won't be part of their debt side, really, but it's going to be more front and center for lawmakers and other officials and the public to see that number more easily and know that it's there. Jason, anything else?
Well, it takes a lot of money to manage this much money. So if you're covering pension funds themselves, they throw off a lot of business, and that's something to look at as well. In fact, the former head of CalPERS is in trouble. He's under indictment. He's more than in trouble for charges related to funneling some work to a money manager or company that he later went to work for. So another thing to look out for.
That brings up the questionable practices I said I would talk a little bit more about. So I talked about spiking. That would be somehow boosting your pay during your high earning years in order to get a better pension. And that really depends on what's allowed in your state to be included as part of that final average salary. In some states, a retirement bonus could be counted toward your salary. Maybe you're cashing out unused sick or vacation time might be included. States have been starting to crack down on this. They're called anti-spiking measures. Like Jason mentioned, California has eliminated overtime from its final average salary calculation, but I believe it's only for new hires, right, Jason?
I am not sure on that.
I'm pretty sure that's the case.
2 of the 10, only 2 of the 10 applied to current workers.
Yeah, so. And so any kind of those gimmicks where they get a bump in pay at the end of their career that would make their benefit higher. And I'm going to show you a story I did on that in a minute. The other thing is that idea of pensions fatter than paychecks. That one's a little tricky, though, because of those cost of living adjustments. But it also goes in hand with the spiking. That's generally the main way people can get a pension that's fatter
Right.
than their paycheck was.
There are a lot of ways to manipulate the formula, and if someone has just left their job and is taking home more in pension than they made on the job, that's a red flag right there.
Yeah, yep. We talked about the double dipping or the return to work, where you leave and then you go back to work. That would be worth looking at. I know the funds here actually keep track of how many people and who is going back to work. We were able to get from one fund an actual list of people who had gone back to work and how much they were making in their new jobs. So that would be something you could do.
There is another side of this, though, because it may actually be cheaper for a government to hire somebody back who is already receiving a pension because you are not paying for that person's health care or pension benefits. So if you had to hire a second person to do that job, you'd be paying other costs that you won't have to if you hire somebody back.
The other
Just
thing that I think the public, when they hear this idea of double dipping, they get completely, crazy. They think it's just insane, but they probably don't understand the details. Generally, someone who does this, they don't improve their pension at all. Once they start taking their pension, that's it. Even if they go back to work, they don't get to add to their pension. So they go back to work, yes, they're getting a salary on top of their pension, but they're not making their pension any better, which takes some of the bubble off that story idea. But the flip side would be, if this is happening at too big of an extent, where a city, for example, is hiring way too many retirees back and not paying into the pension, it could be problematic for the pension. And one of our pensions here actually did a study because they were concerned about this. They were concerned that there might be too many positions where they should be getting, money coming in through a contribution, but they're not because of this return to work idea. So maybe that's the side where there's a story, not so much the, oh my God, this guy is double dipping kind of thing. The other ones are like a sweetheart deal for an individual, and one of the story examples we're going to give you is the Chicago Tribune did a series of stories where they found, like the legislature approved a measure for one guy to get some special deal, somebody, and like the other idea of pension tacker, somebody got allowed to be in the pension even though they really weren't. They worked for one day, quote, imagine air quotes here, worked for one day as in something, and suddenly they get a $50,000 a year pension. Those would be things to look for, and the Chicago Tribune has done a brilliant job of ferreting those out in Illinois. The other one is convicted felons receiving pensions if your state does not allow it. I recently discovered that there's like one subset of police officers who would not be able to get a pension if they got a felony, but all the other police officers who are under a different set of rules could continue to get a pension even if they have a felony. So it really depends on your state.
So this just happened actually in California. You probably all heard of the Bell California scandal, where these public officials were drawing up some exorbitant salaries for themselves and exorbitant pensions as well. Most of them were I think all but one was just convicted of misappropriation of public funds. That's a felony. Under the new reforms, they would not normally be eligible for their pension, or at least it sounds that way, but that if you look at the fine print, that only applies up to the point where you started committing your crime. So they would be eligible for any pension that they earned before the onset of the conspiracy.
Crazy.
Yep.
We've already covered that one, so I'm going to skip it. So one of the things you could do is try to request data from your pension funds on everybody who's receiving a pension. So now this is going to be a crapshoot as to whether or not you can get it. I went through stories in the Investigative Reporters and Editors archive to find other news organizations who have done this, and it was really all over the road as to whether or not they could get anything, and what extent of information they could get. So for example, in Minnesota, all we can get is the name of the person receiving a benefit, the amount of their most recent monthly check, and whether they're a regular retiree or a disability retiree receiving a disability pension, or if they're a survivor receiving survivor benefits from another worker. The rest of these things I can't get anywhere near. So that data is almost completely useless for me, because these pension funds, these big, huge pension funds, cover every state worker in the state. For example, one of the funds I found 40 different people named Barbara J. Johnson. And I have no idea who those 40 people are. I have no idea where they worked, what city they live in, nothing. When they retired, nothing. So, but maybe in your state you could get something more. And this is a list of the things you would want to try to get if you can get it. And this would allow you to look at things like pension spiking, who's getting more money in their pension benefits than they made as a worker. If you could get the kind of the benefit history, you could get a sense of how many people have been collecting benefits for 30 or 40 or 50 years. There's a variety of questions you could ask if you could get all of this data, but you might not be able to. It's really going to depend on the public records laws in your state.
And
so
you'll run into some of those same problems in California. They're not. Employees will move between different agencies, so CalPERS really doesn't track employment history once they become retirees. It'd be good if they have a unique employee ID number to get that, so you can maybe match it up to other databases that you can get your hands on.
Yeah, like salary data or something.
Yeah.
So we've got a few story examples, and we'll move on to questions. Jason, you want to talk about this one?
This is part of a large package we did on public pensions last year. I think we rolled out, it felt like about 20 stories, looking at kind of every fund in the county. And this is sort of at the onset of changes where the county was going to the employees and asking them to start picking up some of the tab because the county was getting hit with a lot of bills. And this just kind of goes over a lot of the issues involved in the debate.
I've been doing a bunch of stories too. The first one we did was looking at pension spiking in the St. Paul Fire Department, and because we couldn't get that the data from the pension fund itself, we ended up using city salary data, which included the number of, for each year, it showed their total pay, how much overtime pay they had, their total hours, and how many overtime hours. So then we were able to look at those hours in particular and see people who were working huge amounts of hours and find a pattern there. What we found is there's a group of supervisors who had gotten a clause inserted into their union contract that guaranteed them a certain amount of overtime each year, and then also gave them right of first refusal before any of their shifts could be awarded to a lower ranking employee. And so what ended up happening is these guys were racking up 400 to 700 hours of overtime a year, while overtime among the rank and file had actually declined. And this, caused a little bit of a stir, but we haven't seen any legislative action yet to try to stop spiking, but we're waiting. And then I mentioned earlier that I also did a story that really looked at what's the financial situation with Minnesota pensions. And one thing I'll point out on this is that I talked to my editor about writing it in a way so that I educated my readers about pensions in addition to telling them what the financial situation was. So there's a lot of extra paragraphs in here that kind of explain what is an unfunded liability, what's the basic premise of how these defined benefit plans work. A lot of these things that we told you at the beginning of this webinar. And my editors were completely on board with this idea of a slightly longer story but written in a way that it taught readers to understand what it is that they were reading, so that it's not just a bunch of numbers and thrown out at them. So if you want to do a story like this, I recommend you take a look at this for some ideas of how to pull that off. And my readers really responded with huge praise for the story and really liked that it was easy to understand. A few others, Rhode Island is one of the states that has really overhauled their pensions significantly, and this is kind of the impetus for it. The story that I'm blanking on the name of the newspaper did now, the Journal, in what city? I can't think. What's the capital city in Rhode Island? Anyways, it's a really interesting story, and there's a link to it on your handout. And they basically did that same story. What is the financial situation, and laid it all out. And then I mentioned Pension Games by the Chicago Tribune. This is a series of stories where they found a lot of questionable practices throughout the pension system there. And that's really good watchdog journalism. And then here's an interesting kind of overview one from USA Today, where they went and looked at legislation around the country to find that legislators in 33 states were positioned to benefit from special retirement laws that they or their predecessors had enacted. So, they were basically boosting their own pensions. Our handout has the links to all of these. These are some of the big places where you're going to find a lot of good information on these issues. There's many more on the handout, as I mentioned. I'm going to open it up to questions. If you're on your webinar, there's a way to raise your hand, and I think Ed has raised his hand, so I'm going to unmute him so he can ask a question. And if you want to ask a question, either figure out how to raise your hand in the webinar thing, or there's a way to type in the chat area, and you can type your question there. Ed, can you hear me? Ed?
Update on social media.
Ed, do you have a question? Okay, we'll move on. Let's get some other questions going. Did we really cover everything that good? There must be questions. Here's one. Mary? Is it Gatsby 45, I think is her question. I think she's asking if that's the standard change. I don't know offhand, but you can email me and we'll try to figure that out. Norb Franz, did you have a question? Angela? Am I not getting this to work properly?
Somebody want to try typing a question as well?
Angela, you should be able to talk or type a question. Well, here we go. Is there an annual pension amount as a percentage of regular salary that experts or readers find unacceptable or egregious? I don't know offhand. I know that I think as Jason mentioned, 25% of pay is kind of the top end, right, Jason?
Yeah,
Like
I
total,
mean, if you're getting up, yeah, if you're getting up there, you know what that means is if you have a $100 million payroll, you're paying another $25 million towards the pensions, and I think that's not going to be palatable to a lot of readers. I think it's just sort of your judgment call on what your readers are going to feel. You know, I think somewhere in the range of the low to mid to high single digits is basically what employees pay, and I think that some public safety personnel pay more actually. But I think that something comparable would be generally acceptable to readers.
I've put up on the screen the press release from GASB regarding the pension accounting and financial reporting standards. You can also find, I think if you Google some of this, you'll find some of these pension organizations that are listed on our handout. They have, a lot of them have written about this, you know, put commentary and things like that. Okay. So Mary, hopefully that answers your question on the GASB standards that you're looking at. Her other question is, have you looked at high and low end benefit recipients, profiled it from the EE point of view? Not sure what you mean by EE, Mary. The high and low end benefit recipients, it's going to be tricky to do that, largely because it just really depends on how many years they worked. There's a lot of people who leave public service after just, employee, have left public service after just, they've vested and they got the minimum, or they got kind of a medium number of years, and then they're out. It brings up another point I wanted to make, is that a lot of the pension funds are really big about promoting this idea of our pensions are modest. The average pension is only $1,000 a month or something like that. But you have to be really careful with that number, because they usually calculate that number using everybody who's collecting a pension, even those people who worked for just 5 years or 10 years and are getting a real nominal amount in their pension. So if you want a true average, you need them to calculate what's the average for people who worked a full 30 years, or worked until normal retirement age.
Who have the full pension, yeah.
Yeah, they have the full pension.
You also hear that from unions as well.
Yeah.
Annual benefit, average annual benefit is only $9,000. This is modest. There's nothing to see here.
Yeah, yeah. Mary, I'm not sure if we really answered your question, but if not, please type in, a follow-up to that. Angela, can you offer specific suggestions about covering a county pension system versus state? Let's see. Well, I think you're going to probably you might be more likely to find problems and more interesting things at that county or local level. As I mentioned, the 2 local funds in Minnesota that we have remaining they're both teacher funds. They are in the most financial trouble out of any of them. Once they go into those statewide pooled systems, they get the benefit of that efficiency thing, where they put so many people together. It just improves the whole financial picture.
Right. So my local county, my local agencies, police and fire, all members of CalPERS. If your county is running its own pension plan, I think a general rule of thumb is that's not a good idea. They tend to run into trouble, and they tend to ask for bailouts from the state, which I think happened in Minnesota, right?
Yep, the 2 local pensions asked for bailouts this year. We're waiting for the legislature to decide. The plan right now is that those funds are each going to get $6 or $8 million per year out of general funds to prop them up, basically for the next 25 years. And I'm kind of stunned that there aren't more people up in arms over this, and the legislators don't seem to be too terribly up in arms over it. But I've been writing about it, and my readers are really glad to see that I'm at least paying attention to it. What other questions do we have? Did we answer everything for everyone? Nothing? Well, I will put up here the last slide. Oops. My PowerPoint went out. Hold on. There's the URL for the handout and this PowerPoint. I'll leave them up there indefinitely. And then our contact information. Okay, I got one more question here. Pew sent a report also noted governments aren't pre-funding retiree health care. Have you tackled that? No, I have not, but it's on my to-do list. For those of you who aren't aware of this, retiree health care is a whole nother ball of wax that kind of gets looked at in conjunction with pensions, but they are really separate issues. And most states do not pre-fund those programs. Minnesota, the Pew report actually hugely chastised Minnesota for not, for being way in the hole on theirs. They have no money set aside to pay for theirs. Other states do fund it. It is something I want to look at, and I think there's going to be some, I think we're going to see a lot of changes in retiree health care, possibly because of the Affordable Care Act. I think the whole system of health care is kind of changing a lot because of that. So it's going to be kind of tricky. But that is another thing to pay attention to. Anything else? Uh-oh. Can you hear me? Jason, can you hear me now? Jason? Jason, can you hear me? Jason, can you hear me?
There you go.
Okay. I think I muted you. Sorry.
That's no worries.
We had one more question here. I hope everyone else can hear me. The question is, how do you tackle this kind of sentiment? Well, we get paid less in the public sector. There are a lot of reports out there about this topic, and it's not, I've seen some reports that say it's not quite true, and that actually public sector pay has increased in recent years to the point that it's leveling out. But that is the thing.
I think that is a legitimate question. I dealt with it a little bit in my story, and I think there's a lot of debate whether the pay is in line or out of line with the private sector. One thing that's not really debatable is, with public sector employees don't get stock options. They don't get those kinds of large bonuses and things like that. So there's a trade-off. They'll talk about a trade-off in going to work for the public sector a lot.
Yeah, and the other thing is, I'm personally of the viewpoint that defined benefit pensions are great as long as they're being managed properly. And so that's the key thing we should be looking at. are they being managed properly so that they will not end up being this huge burden on future taxpayers? It's not that we're wanting to, we're not advocating taking away pensions, saying, oh, you don't deserve to have a pension because none of us have a pension kind of idea. And I think that gets around that, if you're focusing your reporting on are these things being managed properly and what can be done to change it so that they will be around for our grandchildren and great-grandchildren and great-great-grandchildren, then you can get around that whole pay equity issue.
And one of the things you're asking elected officials to do when you're asking them to manage it responsibly is go against the interests of the people that helped elect them. So that is kind of one of the interesting ongoing questions in pension funding these days.
Yep. All right, I think we'll wrap it up. We ran a little long. Thank you, everyone, for attending. As I mentioned, there'll be a recording of this, so you can share with your colleagues, and feel free to email either Jason or I if you have any remaining questions. And good luck with your reporting. Please send it out if you write something. I'd love to see what you end up doing.
Thanks, everyone.